Friday's trading session witnessed something extraordinary. Within hours, coin shop owners across the nation reported the impossible. One dealer, overloaded with inventory just days before, suddenly faced empty shelves. But here's what nobody's talking about. While paper markets collapsed, physical silver was vanishing. The question isn't why silver dropped. The question is, what does this massive disconnection actually mean? And more importantly, what happened next that caught even the most experienced dealers completely off guard? Welcome back to Silver Radar. We appreciate you being here today. Now, if you've been following precious metals markets for years, decades even, you know that moments like these don't come often. We'd like to ask you something, a small favor. If you find value in this kind of serious market analysis, the type that cuts through the noise and gets to what actually matters, would you consider subscribing to our channel? Just click that subscribe button below. It helps us continue bringing you this level of detailed economic intelligence. And while you're at it, we're curious. Where are you watching this from today? Drop your location in the comments. Are you watching from the States, Canada, Europe, Australia? We want to know where our community of serious investors and business minds is tuning in from. Now, let's get into what really happened when silver dropped and why it matters far more than most people realize. The financial markets opened routinely that Friday morning. Silver was trading within expected parameters. Nothing particularly unusual caught the attention of most analysts. But within hours, something shifted. The price of silver began declining, not gradually, but with intensity that immediately signaled this was different. By midday, the precious metal had experienced one of its sharpest single-session drops in recent memory. Trading desks watched as electronic screens flashed red, futures contracts tumbled, and the paper market for silver entered what can only be described as a controlled panic. Yet here's where the story takes an unexpected turn. While financial analysts were focused on charts and technical indicators, a completely different phenomenon was unfolding in an entirely separate market. The physical silver market. Coin shop owners from different states, operating independently, with no coordination between them, began reporting something remarkable. Their phones were ringing continuously. Customers were arriving in person, forming lines that extended beyond normal capacity. And these weren't casual inquiries. Josh from Minetcoin and Bullion describes that Friday as perhaps the most stressful day he's experienced in his shop. He was alone. No staff, no family members available to assist, and from the moment the price drop accelerated, his shop transformed into something resembling organized chaos. People were arriving to sell. That part made logical sense. When prices drop sharply, some holders panic. They liquidate positions. They cut losses. This is standard market behavior documented across decades of financial history. But simultaneously, and this is the critical observation, buyers were arriving in equal numbers. Not just arriving, but buying aggressively. Josh found himself managing multiple customers simultaneously, placing one person in a corner with a tray of products to examine, while quoting prices to another, while answering phones that wouldn't stop ringing. The difficulty wasn't just volume. It was the complexity of operating in a market where prices were moving in real time. Every quote he provided had a shelf life measured in minutes, sometimes seconds. How does a dealer quote prices when the underlying asset is in free fall? How does he maintain fair pricing for both buyers and sellers when volatility has rendered traditional pricing models temporarily irrelevant? Mike from Mid-America Coins reported a strikingly similar experience. Just 1 week prior, his inventory situation had been problematic for entirely opposite reasons. He was overloaded, silver was sitting in his shop with nowhere to go, the market had been quiet, buyers were scarce, and inventory was accumulating. Then came Friday. By the end of that single trading session, his inventory situation had reversed completely. Products that sat untouched for days were suddenly moving. Items that typically required marketing effort were being requested specifically. And by weekend's end, he was facing something he hadn't anticipated. He was nearly sold out. This pattern repeated across multiple dealers, different cities, different market conditions, yet the same basic phenomenon. Now, here's what makes this economically significant. The paper market and the physical market were sending contradictory signals. In traditional market theory, when prices fall, demand should decrease. Lower prices typically indicate reduced interest, weakening fundamentals, or shifting investor sentiment away from an asset. But the physical market was demonstrating the opposite. Falling prices were triggering immediate and substantial demand increases. This isn't just interesting, it's diagnostic. It reveals something fundamental about how different market participants view the same asset. For paper market traders, silver's price drop represented risk, potential further losses, a signal to exit positions or short the market. For physical market buyers, that same price drop represented opportunity, a chance to acquire tangible assets at temporarily reduced prices. The divergence suggests these aren't just two different markets trading the same commodity. They're two fundamentally different asset classes that happen to share a name. One exists as electronic contracts, settled in cash, subject to leverage and derivative complexity. The other exists as physical metal, requiring storage, immune to counterparty risk, and subject to the basic economic principles of supply and demand. What happened that Friday wasn't just a price movement, it was a stress test. A real-time experiment revealing how quickly physical markets can decouple from paper pricing mechanisms when volatility reaches certain thresholds. And the results of that stress test? Well, that's what we need to examine next. Because what dealers experienced on Friday was only the beginning. The operational mechanics of a precious metals dealership operate on fundamentally different principles than most retail businesses. When Josh opened his shop that Friday morning, he possessed years of experience managing customer flows, pricing volatility, and inventory turnations. None of that experience fully prepared him for what transpired over the following 8 hours. A coin shop operates as a unique economic junction point. It sits directly between large-scale distributors and individual retail customers. It must simultaneously function as a buyer and a seller, often within the same transaction window. The dealer must maintain sufficient capital to purchase incoming inventory while simultaneously managing outgoing inventory to meet buyer demand. This dual function creates inherent operational complexity that intensifies dramatically during periods of market stress. Josh's Friday began with the phone ringing before he unlocked the front door. The first caller wanted to know his current buy prices for Silver Eagles. The second caller, just minutes later, wanted to sell a substantial quantity of generic silver rounds. By mid-morning, the phone calls had multiplied to the point where answering them began interfering with his ability to serve customers standing physically in his shop. The challenge wasn't simply volume. Volume can be managed with additional staff or extended hours. The deeper problem was the fundamental impossibility of providing accurate pricing in a market experiencing violent real-time fluctuations. When a dealer quotes a buy price, that quote carries an implicit time window. Under normal market conditions, a quote might remain valid for 30 minutes or even an hour. On this particular Friday, quotes were becoming obsolete within 5 to 10 minutes. Consider the operational dilemma from the dealer's perspective. A customer arrives with silver to sell. The dealer examines the items, verifies authenticity, and calculates a purchase offer based on current spot prices plus his operational margins. But while this evaluation process unfolds, the underlying spot price continues moving. By the time the dealer extends his offer, the market price may have shifted sufficiently to render his initial calculations inaccurate. If he quoted too high, he immediately loses money on the transaction. If he adjusts downward mid-negotiation, he risks offending the customer and losing the deal entirely. Now multiply this scenario across dozens of simultaneous interactions. Josh described physically placing customers in different areas of his shop while he rotated between them. One customer would be examining a tray of silver bars in the corner. Another would be waiting at the counter for a quote on their gold coins. A third would be on hold on the telephone. And Josh moved between them, attempting to provide each person with accurate information while the market continued its relentless downward movement. The psychological pressure on dealers during such events extends beyond mere operational stress. Every purchasing decision carries financial consequences that materialize within hours or days. If a dealer buys too aggressively at what he believes is a low price and the market continues falling, he immediately experiences inventory losses. If he refuses to buy, anticipating further declines, he loses the opportunity entirely, and his inventory depletes without replacement. The decision-making occurs in compressed time frames with incomplete information and substantial financial exposure. What makes this particular event analytically significant is the behavior pattern among customers. Standard economic theory suggests price declines should sort market participants into clear categories. Sellers should dominate as holders rush to exit positions. Buyers should wait, anticipating further declines before committing capital. But Josh's shop demonstrated a more complex reality. Sellers arrived throughout the day, but their motivations varied substantially. Some were clearly panic-driven, wanting to liquidate immediately regardless of price. Others were methodical, apparently executing predetermined exit strategies triggered by specific price levels. A third category seemed almost reluctant, selling not from fear, but from immediate cash needs unrelated to their views on silver's future value. The buyers presented equal complexity. Some arrived with shopping lists, having clearly waited for a price decline to execute planned purchases. Others appeared opportunistic, responding to the price drop with minimal advance planning. A particularly interesting subset consisted of existing customers who had been selling into the rally of previous weeks and were now reversing course, buying back positions at lower prices. Mike from Mid-America Coins reported an almost identical pattern despite operating in a different geographic market. His inventory transformation from overloaded to depleted occurred across just 7 days. The previous week had seen minimal buying activity and substantial selling pressure. His warehouse was accumulating inventory faster than retail demand could absorb it. Then Friday arrived, and within hours, the inventory equation inverted completely. By Saturday morning, Mike was fielding calls from customers seeking products he no longer had in stock. Items that sat untouched for days were suddenly unavailable. The velocity of this transition exceeded anything in his operational experience. This wasn't gradual inventory normalization. This was a complete market state change compressed into a single trading session. What both dealers experienced reveals critical information about physical precious metals markets that remains invisible to analysts focused exclusively on futures contracts and exchange-traded products. The physical market operates with friction, delays, and human decision-making processes that differ fundamentally from electronic trading. Yet during this event, the physical market demonstrated remarkable responsiveness despite these inherent limitations. The question becomes whether this dealer-level activity represents isolated incidents or symptoms of broader structural market conditions. The answer to that question determines whether Friday's events constitute a temporary anomaly or evidence of something more significant developing beneath the surface of precious metals markets. Economic textbooks describe market equilibrium as a state where supply and demand intersect at a mutually agreeable price point. This theoretical framework assumes rational actors, perfect information, and frictionless transactions. Friday's events in the physical silver market demonstrated how dramatically reality diverges from these academic assumptions when psychological factors collide with tangible asset scarcity. The transition Mike experienced from inventory surplus to near depletion within 7 days represents more than simple supply and demand rebalancing. It exposes a fundamental characteristic of precious metals markets that receives insufficient attention in mainstream financial analysis. Physical silver exists in finite quantities at any given moment. Unlike stocks or bonds that can be created through issuance or derivatives that can be manufactured through contractual agreements, physical metal must be mined, refined, fabricated, and distributed through supply chains that operate on timescales measured in weeks and months rather than milliseconds. When price movements trigger simultaneous demand surges across multiple geographic markets, the physical supply chain cannot respond with the speed that electronic markets take for granted. A futures trader can establish a position in seconds. A retail buyer seeking physical silver eagles must locate a dealer with inventory, negotiate pricing, arrange payment, and either take physical possession or arrange secure storage. Each step introduces friction, delay, and potential failure points. This friction normally acts as a stabilizing mechanism. It prevents the kind of instantaneous liquidity evaporation that occasionally paralyzes purely electronic markets. But during extreme price movements, the same friction creates a phenomenon that financial engineers call demand compression. Buyers who might have spread their purchases across weeks or months suddenly attempt to execute simultaneously, creating temporary scarcity even when adequate metal exists within the broader supply system. The psychology driving buyer behavior during sharp price declines follows patterns documented across multiple asset classes and historical periods. A subset of market participants maintains predetermined price targets below current market levels. They wait patiently, sometimes for months or years, for prices to reach their target entry points. When those targets trigger, these buyers execute with conviction because the market has finally met their predetermined conditions. A second category operates more opportunistically. These buyers lack specific price targets but maintain general awareness of historical price ranges and relative value. When prices drop substantially within compressed timeframes, they interpret the movement as potential opportunity, even without detailed analysis supporting that interpretation. The speed and magnitude of the decline itself becomes the signal, triggering action based on pattern recognition rather than fundamental analysis. The most economically significant buyer category consists of those who understand the structural disconnect between paper and physical markets. These participants recognize that futures market pricing occasionally diverges from physical market realities due to the different mechanisms governing each market. When paper prices fall sharply, these buyers view it as a potential inefficiency to exploit by acquiring physical metal at temporarily depressed prices before the two markets realign. Seller behavior during the same period reveals equally complex motivations. The panic sellers represent the most visible category, but not necessarily the most numerous. These individuals purchased silver at higher prices, watched their positions deteriorate, and reached psychological breaking points that triggered liquidation, regardless of loss magnitude. Market technicians call this capitulation, and it typically marks temporary price bottoms because it represents the final exhaustion of weak holders. Strategic sellers operate from entirely different frameworks. Some had accumulated positions at substantially lower prices and viewed Friday's decline as merely a profit-taking opportunity from still favorable levels. Others were executing portfolio rebalancing strategies triggered by silver's percentage weight, exceeding predetermined allocation limits. A particularly sophisticated subset was selling physical metal while simultaneously establishing or expanding futures positions, essentially trading physical premium for paper leverage. The dealers found themselves functioning as involuntary market makers in this chaotic environment. Unlike exchange specialists or designated market makers who receive compensation and regulatory protection for providing liquidity, retail dealers absorb the risks of bridging buyer and seller flows with their own capital and inventory. When Josh quoted prices to simultaneous buyers and sellers, he was effectively creating a micro-market within his shop, and his financial survival depended on managing the bid-ask spread while absorbing inventory risk. The inventory transformation both dealers experienced points to a critical vulnerability in precious metals market structure. The retail dealer network operates with relatively thin capital reserves compared to institutional market makers. Most shops cannot afford to warehouse unlimited inventory during quiet periods, nor can they instantly replenish stock during demand surges. This capital constraint means dealer inventory levels function as real-time sentiment indicators, potentially more accurate than surveys or positioning data derived from futures markets. When Mike went from overloaded to sold out in 7 days, that inventory swing represented actual metal-changing hands with actual money at actual prices. No leverage, no hypothetical positions, no paper proxies. Each transaction represented a discrete decision by an individual to exchange cash for metal or metal for cash based on their assessment of value and future price direction. The academic term for what occurred is price discovery, but the phrase inadequately captures the messy human reality of the process. Price discovery in electronic markets happens through algorithms executing against order books in microseconds. Price discovery in physical markets happens through phone calls, in-person negotiations, trust relationships built over years, and handshake deals consummated in coin shop backrooms. What Friday's price collapse revealed is that these two discovery mechanisms can produce dramatically different conclusions about the same asset as value. Paper markets concluded silver should trade lower. Physical markets concluded the lower price represented buying opportunity. Both markets were simultaneously correct within their own operational frameworks, yet completely contradictory when viewed holistically. This contradiction carries implications extending far beyond a single day as trading activity, or even the precious metals market specifically. It demonstrates that in an increasingly financialized economy, where most assets trade primarily as electronic abstractions, physical manifestations of those assets can develop independent pricing dynamics driven by factors the electronic markets fail to capture. The events surrounding Friday's silver price collapse constitute far more than an isolated market incident worthy of brief attention and subsequent dismissal. They represent a documented case study in market structure fragility that carries actionable intelligence for anyone operating at the intersection of finance, commodities, and strategic asset allocation. The question facing business strategists and institutional planners is not whether similar events will recur, but rather how to position for maximum advantage when they inevitably do. Historical market analysis reveals that physical paper market disconnections in precious metals follow recognizable patterns across decades of data. The 1980 silver market manipulation, the 2008 financial crisis precious metal surge, the 2011 retail shortage during European sovereign debt fears, and the 2020 pandemic-driven supply disruptions all demonstrated variations of the same fundamental dynamic. When stress enters the financial system through any vector, a subset of market participants immediately shifts preference toward tangible assets with no counterparty risk. This shift happens regardless of whether the particular stress event logically connects to precious metals fundamentals. What makes recent events potentially more significant than historical precedents is the magnitude of the structural imbalances that have accumulated within precious metals markets over the past 15 years. The ratio between paper claims on silver through futures, options, and exchange-traded products versus actual physical silver available for delivery has expanded to levels that would be considered operationally impossible in most commodity markets. Industry estimates suggest paper claims exceed physical availability by factors ranging from 100 to 1 up to several hundred to 1, depending on calculation methodology. This disparity creates inherent fragility. Under normal conditions, the vast majority of paper contract holders never attempt physical delivery, allowing the system to function despite the imbalance. But during periods when physical delivery requests increase even modestly above baseline levels, the system experiences stress disproportionate to the magnitude of the delivery requests. Dealers deplete inventory not because metal has become genuinely scarce in absolute terms, but because the distribution network lacks capacity to rapidly redirect metal from wholesale channels to retail demand points. For institutional actors and business strategists, this market structure creates both risks and opportunities that demand careful analysis. The risk dimension centers on counterparty exposure within paper markets. Any entity holding precious metals exposure exclusively through financial instruments remains vulnerable to scenarios where contract performance becomes impaired by delivery failures, exchange rule changes, or regulatory interventions during crisis periods. These tail risks receive minimal attention during stable market conditions, but can materialize with startling speed when systemic stress emerges. The opportunity dimension emerges from understanding that physical paper disconnections create temporary price inefficiencies exploitable by those positioned to act decisively. When paper prices fall sharply, but physical premiums expand or availability contracts, a clear arbitrage signal emerges for those capable of taking physical delivery and holding through the dislocation period. This strategy requires capital availability, storage capability, and patience to allow the markets to realign. But the historical success rate of such positioning during past disconnections provides compelling evidence of its validity. Operational preparedness for navigating volatile precious metals markets requires relationship infrastructure built during calm periods, rather than assembled frantically during crises. The dealers who successfully managed Friday's chaos were those with established customer relationships, pre-negotiated credit lines with suppliers, and operational systems capable of handling surge volume. Similarly, buyers who successfully acquired physical metal at favorable prices were typically those who had already established relationships with dealers, understood pricing mechanisms, and maintained ready capital for deployment. The forward outlook for precious metals markets exists within a broader context of unprecedented monetary policy experimentation, elevated government debt levels across developed economies, and geopolitical tensions that show little sign of resolution. Whether these macro factors ultimately drive precious metals prices higher or lower remains genuinely uncertain. What appears considerably more certain is that volatility will persist and potentially intensify as these structural pressures continue developing. For business entities considering precious metals as either operational inputs or strategic reserves, the Friday incident offers clear lessons about the importance of distinguishing between paper exposure and physical holdings. Companies requiring actual metal for manufacturing or other productive purposes cannot rely on paper markets to deliver during stress periods. Those treating precious metals purely as financial portfolio diversifiers must carefully consider whether their paper positions will function as intended during precisely the crisis scenarios that would make precious metals insurance valuable. The competitive intelligence dimension of dealer-level market activity deserves particular emphasis. Large institutional players and government entities monitor futures positioning data, mining output statistics, and import-export flows. These data streams provide valuable macro-level insights, but arrive with substantial time lags and aggregation that obscures ground-level developments. Retail dealer networks, by contrast, provide real-time sentiment and demand signals directly from end users, making actual allocation decisions with actual capital. Building intelligence. Gathering relationships with dealers across different geographic markets creates an early warning system for sentiment shifts before they become visible in official statistics or widely recognized by mainstream analysts. Josh and Mike both possessed valuable information about physical market conditions days or weeks before that information would appear in industry reports or government data releases. For institutional actors, accessing this dealer-level intelligence network represents a significant informational advantage. The monitoring framework for assessing precious metals market stress should incorporate both traditional metrics like futures positioning and volatility indices, alongside physical market indicators like dealer inventory levels, premium structures, and delivery timeframes. When these two data categories begin diverging significantly, with paper markets showing weakness while physical indicators show strength, the probability of a meaningful dislocation increases substantially. Strategic positioning for various scenario outcomes requires acknowledging genuine uncertainty about directional price movements while preparing for volatility and potential supply disruptions, regardless of direction. This means maintaining optionality through diversified exposure across both paper and physical holdings, establishing dealer relationships before they become urgently needed, and developing operational playbooks for rapid execution when opportunity windows open during volatile periods. The final consideration centers on the competitive advantage available to those who deeply understand physical market dynamics in an era when most market participants focus exclusively on electronic trading and paper instruments. As financial markets become increasingly abstract and removed from underlying physical realities, the operators who maintain connections to actual physical flows position themselves to exploit the disconnections that inevitably emerge when paper abstractions collide with physical constraints. Friday's silver drop was not the beginning of this trend, nor will it mark the end. It represents one visible episode in an ongoing structural evolution of commodity markets, where paper and physical increasingly operate as separate ecosystems with only intermittent connection points. Understanding this evolution and positioning accordingly separates strategic operators from those who will find themselves surprised and disadvantaged when the next dislocation arrives without warning.